In this lecture, I want to talk about the long put position. Now, a long put position is basically just buying a put option. And you do this when you think a stock is going to go down. It's a leveraged bearish trading strategy. So a long put position will move more than just being short the stock, because one put option allows you to control 100 shares of stock. And so like the long call position, this is a leveraged way of trading, though it has a bearish outlook rather than a bullish outlook, as we saw with the long call. Now, it's less risky than shorting a stock simply because a stock can go up a lot, and as it goes up, if you're short, you can lose a lot of money. Theoretically, stock could go to approach infinity. Whereas if you're long a put, your maximum loss, even if the stock goes up a lot, is limited to the price you pay for that put, the premium that you pay. So that's one really nice thing about put options. You can put them on. You can sleep at night not worrying about going bankrupt because the stock goes up a lot. You already know when you enter the trade what your maximum loss is. Now, why is it called a put? Well, a put option gives you the right to sell the stock at the strike price of the put option. You can theoretically put the stock onto someone else at that strike price anytime before expiration. And just as we saw with the long call position, a long put position is also one of those basic building blocks of other more complex option strategies, including bear put spreads, long straddles, etc. Now let's think about how put options are priced. Let's say that you have a put option with a strike price of 100, and that gives you the right to sell 100 shares of that stock at any time before expiration at 100, to basically put those shares away on someone else. Now this is, again, even if you don't own the shares of the stock, you still have this right. Now let's say the stock is trading at $90 a share, and you're looking at that put option on that stock that has a strike price of 100. Now we know, this says call option, but this should say put option here. Sorry about that. So that put option should be worth at least 10, since you could theoretically, and this is all intrinsic value, since you could theoretically exercise the put option, which means sell the shares at 100, put the shares onto someone else, in other words, sell short the shares, and then you could immediately go in the open market and buy 100 shares of the stock at where it is trading right at 90 and cover your short. And you'd lock in a $10 profit there, a 10-point profit. So that's why a put option that's trading at 90 should be worth at least 10. And then it will be, in addition to this intrinsic value, it will also have some time value or extrinsic value. Now, similar to call options, if you buy a put option, again, this is the price of the option, not the price of the stock, but if you buy one put option for $2 and sell it for $10, you'll make $8 or 8 points. And what you do is you just multiply that by 100 shares per contract times the number of contracts you're trading. So if you're just trading one put option and you capture if you capture 8 points on one put option, that's equal to $800 profit. Just that 8 points times 100 times one put option contract. And again, not counting commissions. Now, what's your max loss? As we discussed, the max loss is just the price you paid for the put times 100. So if you paid $2 for the put, times 100 shares, that's $200, which is just your premium paid. Again, this will always be a debit trade. You're putting money up front to enter the trade. Now, what's your max profit? Well, your max profit on a long put option will occur if the stock goes to zero. So the way we can calculate the maximum profit is just that strike price all the way down to zero. But then we have to subtract the price we paid for the put and multiply by 100. And I'm going to show an example in a later slide. Break-even price of the stock is just going to be the break-even price of this trade. That break-even price of the stock at expiration for this trade is just going to be the strike price minus the price paid for the put. So we already discussed that the max profit is just the strike price minus the price paid for the put times 100. That's, again, the maximum profit will occur if the stock goes to zero. Now, I also wanted to mention that if the stock goes down a lot, the put option delta will become more and more negative, and it will approach -1 or -100, however you like to think about it. And at that point, the put option will begin to move 1 for 1 with the underlying stock, but inversely. So if the stock falls by $1, the put option will move up in value by $1. If the stock rises by $1, the put option will move down in value by $1. Again, this is just what a negative delta of 1 means. It moves 1 for 1 with the stock, but inversely. Now, as your long put option, as the delta approaches 1, it begins to behave just like stock. It's less leveraged. And so at this point, you may wish to sell that put and then use your proceeds, use your profits to buy another put option that's at the money or even a lower strike price, more out of the money. And this will enable you to keep the trade leveraged, because if it's moving 1 for 1 with the stock, it's no longer a really leveraged trade. But by buying at the money or out of the money put options, which again are a little bit more risky, it gives you more leverage. And this is called rolling down the strike price. Maximum loss, again, very simple, just the put premium that you paid. So if you pay $2 for a put option, and the premium will just be $200. So $2 times 100 shares. Again, it's a debit trade, and this max loss will occur if the stock is trading at or above the put strike price at expiration. In that case, the put will no longer have any time value or extrinsic value, and it won't have any intrinsic value because it'll be right at the strike price or above it. Now, break-even price, again, we said it's just going to be the strike price minus the price you paid for the put. So here's an example. Let's say that you pay $3 for a put option. The strike price is $100. So what's the break-even price? Well, it's just going to be 100 minus the price paid for the put option, 100 minus 3. So if this, and that's 97 obviously, so if the stock price is at 97 at expiration, you're going to break even on this trade. If the stock is below 97, as you're very close to expiration or at expiration, you'll begin to have a profit. Let's look at a couple examples here. So here we have a stock price at 100. We're going to buy a put option that's right at the money. The strike price is also 100. Let's say we pay $5 for this put option. Well, that's going to cost us $5 times the 100 multiplier, so $500. And if the stock falls to 90 right before expiration, our put options can be worth approximately $10. It's not going to have any, it's going to have all intrinsic value, no extrinsic value, just that in the money value. So 100 minus 90, it's going to be worth 10 points. 10 points times the multiplier of 100 is $1,000. So it costs us $500. We can sell it for $1,000. We've made $500 on our investment. In other words, 100% return. Now you almost always want to sell a put option before expiration. If you don't sell a put option before expiration and if you hold it into expiration, it will turn into a 100 share short. So after expiration on that Monday after expiration, you'll look in your account, the put option will be gone, and instead you'll be short 100 shares of that stock at that put option strike price. Here's another example. Stock price is 100. Strike price of the put is also at the money. Let's say we pay $5. Again, we pay $500 for this. Now, if the stock is trading right at 95, right before expiration, right at expiration, our put options just can be worth, it's going to be 5 points in the money, 100 minus 95. So the strike price minus the current price of the stock, 100 minus 95. 5 points times the multiplier of 100. Our put option will be worth $500. Now, we paid $500 for it when the stock was trading at 100, and the stock only fell 5 points. And so this is a break-even trade, and we should be able to sell it right for $500 right before expiration, on that Friday before expiration. Now, let's say we do the same thing. We pay $5 for the at-the-money 100 put option. If the stock's trading right at the money, if it hasn't moved at the point of, now it may have moved around a lot before expiration, but if right before expiration, it's right at that strike price, it's not going to have any time value left, it's not going to have any intrinsic value, it's not going to be in the money, and so it's going to be worth 0. Also, if the stock is trading at 100 or above 100, put options can be worth 0, so that means we will have lost 100% of our investment. We've lost $500. And again, that max loss, as you can see, was just the premium that we paid. Now, what do the Greeks look like for a long put? Well, long puts have short delta, as you would imagine, because they're a bearish strategy. They make money. They go up in value when the stock goes down. And so what that means is they have to have a negative delta. Positive delta means something goes up in value when the stock goes up. And a negative delta or short delta means that something goes up in value when this underlying stock goes down. So long puts are a short delta or negative delta trade. They're a long gamma trade. Why is this? Well, the delta of a long put option will increase. Well, it's actually decreasing, but because it will approach -1. So it will decrease, but it will approach that key number of 1. And so what that means is the more the stock goes down, the closer the delta of the long put option will get to -1. And at that point, every time the delta becomes more negative, you will make more and more money as the stock goes down. So as the stock goes down a lot, the delta is going to approach -1, which is very good for a long put holder, because then it gives us more and more exposure to the stock going down. And again, we already mentioned in a previous slide that once your delta gets above 90, 95, 100, or 0.9, 0.95, or 1, at that point you may wish to roll further out to a put option with a lower strike price to increase your leverage. But as the delta approaches -1, the put option will go up $1 for every dollar that the stock falls. Now, if the stock goes up a lot, that negative delta, that -1 delta, or whatever the delta is as you enter, is going to approach 0. So it's a long gamma position. It makes money if the stock moves a lot in one direction, in the negative direction. Long Vega. Again, this is going to be a little bit like putting the cart in front of the horse, but when implied volatility goes up, the value of a long put option goes up. So we can see that in our handy dandy option calculator here. So this is an at the money 100 strike put, 90 days to expiration, 30 vol, and you can see it's trading for 5.71, 5.72. So what happens when vol goes up? We'll increase vol to, and you can see we raised volatility, implied vol, from 30 to 40, and the put option went up to 7.686. And again, you can see if you look at the Greeks here, just as we discussed, the put option has a negative delta. You can see an at the money put option has a negative delta close to -0.5. In this case, it's -0.46. It's got a positive gamma, and you can see the positive vega of 0.197. So call it, you can round this to 0.20. So for every movement in implied vol, every time this moves up one percentage point. So if this goes to 31, if implied vol moves from 30 to 31, we would expect the price of this put option to go from 5.71 to rise 20 cents, and basically to go to 5.91. And as we're going to see now as well, the put options, a long put option has a negative theta. They have time decay. So let me just clarify once again how implied volatility works, and with reference to Vega. Basically, implied vol goes up when more people try to buy a put option. And why is this? Well, more people try to buy a put option. Maybe they're getting very bearish on Tesla, and so there's more and more demand for put options. This drives up the price of the put option. A higher price put option has a higher implied vol, all else being equal. And so that is one reason that basically demand for a put option will increase implied volatility. Higher implied vol, again, just like we saw with the long call, is implying that the stock has the potential to make a larger move. Just like a long call option, a long put option will lose value over time due to time decay or theta decay. So we can say that a put option, a long put, has a negative theta. If the stock just sits there, doesn't move, doesn't fall, it's going to lose value over time. It's like a melting ice cube, just like the long call is. And so you don't want to buy put options on a stock that you think is just going to sit there. A stock that doesn't have a catalyst, you need the stock to move, because every day you're losing a little bit of money holding a put option. And eventually it's going to expire. And it's going to expire worthless if it's not in the money. So that's why you really need to have a catalyst. You need to have a reason that the stock is going to fall between now and the option's expiration, and the put option's expiration. Now, put option with more time value, more time before expiration, will be more expensive. basically you're buying more optionality there than a put option with less time before expiration. So the longer you have for something to happen, the more that option is worth, because obviously if you could buy a put option on something over 100 years, a lot can happen over 100 years. And so that put options can be more expensive than a put option that just lasts for 1 year. So let's do one more example here. Initial stock price is 100. Initial implied vol is 30%. We're going to buy an at-the-money put that struck at 100 that expires in 30 days. We're going to say we pay $3.36 for this put option. That's the price of the put option. So again, our break-even price is just going to be the strike price minus the price paid. So 100 minus 3.36, which is 96.64. If the stock is at 96.64, we break even on the trade. If it's above that, we lose money on the trade. If it's below that, at expiration, we'll make money on the trade. And this is actually a mistake. Potential profit is just going to be equal to the price paid, the strike price minus the price paid for the option, and times 100. So that's the potential profit, and that occurs if the stock goes from 100 to 0. Max loss, again, is just going to be our premium paid up front. So the price of the option times 100. Now, just as we saw with calls, deep in the money calls, or deep in the money calls and puts, in the money calls and puts are going to be priced higher because they have intrinsic value than at the money puts, which are going to be priced higher than out of the money puts. And this is, as we said, because in the money puts include intrinsic value. Now, if you're bearish on a stock, typically you'll buy an at the money put. If you're super bearish, this should be. Sorry about these mistakes. I used the same slide for the call options, so I missed a couple things. If you want to buy an out of the money put if you're super bearish on the stock. Out of the money put means the stock has to fall more, and so you have to be a little more bearish. And again, you pick your strike price based on how far you think the stock could fall before expiration. And is there going to be some catalyst, like an earnings report or other catalyst, maybe an FDA report, something like that, FDA approval or disapproval of a drug. So you need a catalyst. Now, the further out of the money the put option is, the cheaper it's going to be. As we said, it's not going to have any intrinsic value. It's going to be further out of the money. It's going to have a lower delta, which means that it has a lower probability of expiring in the money. And so it's going to be cheaper, but it's also going to have a lower chance of expiring in the money. And so this is sort of the trade-off. You want to pay the least amount of money possible for a put option because it gives you more upside, but you also want to have a good probability. And so this is kind of a weighing act. And again, you should always take a look at that break-even price and think about what it's going to look like at expiration. Just take the option price and subtract it from your strike price. Now, some people, just as we saw with in the money call options, sometimes someone will buy an in the money put option if they want to approximate being short the stock. So maybe you're not allowed to short stock in your account, or it's just an options account. If you buy an in the money put that has a delta of minus 0.9, minus 0.95, minus 1.00, you're going to approximate. It's going to move roughly 1 for 1 down with the underlying stock. So if the stock moves down a point, you'll make 90 cents. If the stock moves up a point, you'll lose 90 cents. Did I say that right? If the stock moves down a point, you'll make 90 cents on your put option. If the stock moves up a point, you'll lose 90 cents on your put option with a 90 delta or 0.9 delta. Again, this is like shorting a stock, but it can, depending on your broker, they may require less capital, and so it's a way of being a little more leveraged. And sometimes if investors do this or short sellers do this, they want to have some real time on the put option, so they'll buy leaps. They'll buy put options that expire in 365 days or more. Now let's say that you buy a leap put option for $10 on a stock that's trading at 100. We're going to demonstrate what the leverage here looks like. And again, it's a put option. It's deep in the money. So it has a very high delta. We're going to assume it has a delta of minus 0.9. If the stock goes down, if you're just short the stock and it goes down a point, you're going to make 1%. The stock moves from 100 to 99. You make 1% on your short stock. But if you have an in-the-money LEAP put option, stock moves down 1%, has a delta, your put option has a delta of minus 0.9, and so you're going to make 90 cents on that put option. You only paid $10 for the put option, and so that 90 cents on a $10 put option is like a 9% move. So being long deep in the money puts with deltas of 90 or more, or minus, I should say minus 90 or less, minus 90, minus 0.9 to minus 1.00 is like a leveraged way of being short a stock. Now again, as we saw with long call options, to enter the trade, you just want to buy to open. You can be going long the put option. You pick the strike price and the expiration based on how long you think it's going to take the stock to move and how far it's going to move. And then to exit the trade, to take profits or take a loss, and you almost always want to exit the trade before expiration. You're just going to sell to close that same put option. Now let's say if you don't, let's remind ourselves of what happens if you hold a put option through expiration. If you hold, let's say you buy one put option with a strike price of 30, and you hold this, there's another little mistake here. This should say put option. So if you hold this put option through expiration, you're going to end up being short 100 shares of that stock, and your sale price will be 30. Again, there's usually not a reason to hold a put option through expiration. Now, there are a couple things that can go wrong with holding puts, and you can be right about the stock and still not make money on the put option. So that's sort of where I wanted to close this thing. If a stock falls, but the implied vol moves down in the meantime, in other words, demand for the put option moves down, you could still lose money on that put option trade. Or if the stock falls, but it takes too long to fall, you could also lose money on the put option trade. Again, notice in both of these cases, we're correct. The stock falls, we buy put options, but we still don't make money. So let's take a look at what that looks like. So let's close this up, and we're going to look at a at-the-money put option. So the stock is trading at 100. We're going to buy an at-the-money put option that's struck right at 100, 90 days to expiration. And let me see here. Okay. So let's, I think this should actually say 30 days to expiration. We could do it with 90 days. It won't make a big difference. So what happens here? We have a put option. These put options here are going to cost us 5.71. So again, strike price at the money right at 100, 90 days to expiration. Risk-free rate is assumed to be 1.71. Dividend yield is 0. Implied vol is 30. And those put options cost us 5.71. Call it 5.72. Okay, so let's see what happens. Well, if the stock falls immediately right after we buy it, if it falls the same day, the stock falls from 100 to 90, our options will go from 5.72 to 11.66. So you can see here they were worth, when we entered, they were worth about 5.72. If the stock falls out of bed immediately, we roughly double our money. The put options are then worth 11.66. We made about approximately 100% on our money, which case we would you could just then sell the options for 11.66 or hold on if you want. Now, what happens if the stock falls to 90, but it takes longer to do that? It takes a long time to do that. Well, let's look at, let's say it takes 80 days to fall, and so we only have 10 days left to expiration. Or let's say we, let's make this even more dramatic. 5 days to expiration. So in this case, we're still, let's say it falls to 95. Okay, So here's an example where the stock, we paid about 5.72 for the put options, and the stock only fell 5 points, and it took 85 days to do that. And so as a result, we were correct that the stock fell, but it didn't fall enough to justify the price of our put option. Our put options, again, at expiration, these are going to be worth about $5 because they'll just be 5 points in the money. We paid 5.72, so that would be an example of a case where we were correct that the stock fell, but in retrospect, we paid too much for the options. The stock didn't fall enough. It took too long to fall, and as a result, we lose money on that trade. Now, let's say it falls to 95, but it does it after. Let's see, we buy this option when it has 90 days to expiration. Let's say 10 days later, so 80 days to expiration, it falls. In that case, we still make money. So you can see that the stock price, we paid 5.72 for these put options. The stock price only fell 5 points, didn't fall as much as we expected, but it happened when there was still a lot of time value left on the puts. And so we entered these puts at 5.72, and we still made money because the stock price fell. If it took 85 days to do it, and we just had 5 days till expiration, then we'd lose money on the trade. But here, there's enough time value left in addition. So there's about, you have $5 here worth of intrinsic value being in the money, and then you have about 3.07 of extrinsic or time value. And that those, if you add those up, 5 plus 3.07, that gets you 8.07. So you need the stock to fall. When you buy a put option, you need the stock to fall as soon as possible, and you also need it to fall as far as possible. Now let me give you another example of where things can go wrong. So let's go back. We're buying at the money put, 90 days to expiration, and let's say that let's see here. So we're just paying 5.72 for this. Now let's say that the stock falls. Again, it falls to 95, and it falls to 95. But it takes a lot of time to do it, and it also, after it falls, so maybe we have like an earnings report, and implied volatility is often high before earnings, and then the day after earnings, implied vol on the options can fall a lot because there's a lot of uncertainty that's been taken out. So in this case, let's say that we have the implied vol falls from 30 to 15, and the stock falls from. So we're sort of right. The stock we were hoping it would fall 10 points, but basically it comes out with earnings. We own the at the money call, and it falls. Let's say just that same day. There's no time decay in this example because we want to just sort of isolate implied volatility. Implied volatility moves from 30 down to 15. The stock falls $5 immediately. We'll say no time has passed. Maybe the earnings came out in the middle of the day. And here's another example of where we basically break even on the trade. So we entered at 572. They're now priced at 574. And we were completely right about the trade. The stock fell 5 points. It happened right away. There was no time decay. But what happened was demand for the puts fell sharply because earnings had just come out. And so implied vol moves got cut in half. This is probably a bit of an exaggeration, but implied vol moved from 30 to 15. As a result, the options don't really go up in value. Maybe they went up 2 cents. And so this would be another example of what can go wrong. So again, what can go wrong is the stock falls, but implied vol drops enough that it offsets all the benefit of that negative delta. Or the stock could fall, and it could fall a lot, but depending how much you paid for the put options, if it takes too long to fall, you can have a lot of theta decay or time decay in the meantime. And so the options could lose money, even though you're right about the stock falling. So again, this is why at the beginning of this course, I compared trading options to to flying an airplane versus driving a car. There are these dimensions of implied vol and theta decay in particular that make it a little bit tricky. And so that's why it's very important to size your option positions correctly, knowing that when you're long a put, if you're very, very wrong and if things go badly, you can lose 100% of your premium. And so when you're making money on put options, you definitely want to try to create your trade such that, or structure your trade such that you're making more than 100%. So if you're risking 100%, you're risking your whole premium. 100% return on an options trade is not that great then, because if you just do that 50% of the time, you're going to break even. You're going to lose 100%, make 100%. So that's why it's more typical, and it's a good thing that on successful options trades, you should be making 500% or 1,000% or 5,000%. So let's summarize long puts. Long puts make money if the stock goes down and implied volatility goes up, but they lose money over time due to theta decay. And so you've really got to get the timing right. You've got to get the size of the move right. And you've got to have reasonable assurance that the implied volatility is not going to drop a whole lot and destroy your profits that way. So we'll talk a little bit more about this when we look at long straddles, but option implied vol is very high going into earnings. It will often fall off. So what I like to do if I'm entering a trade before earnings is I will assume that all of the implied volatility value or time value or extrinsic value goes away. And so I will, in the case we were looking at where I'm entering the option at 100 strike price, 90 days to expiration, the vol is 30. And so what I will do is I will just often, especially if I'm trading into earnings, is I will assume that all of the time value goes away. And I'm going to try to ask myself, what does this put option look like right at expiration? And so what I will do in that case is I will just say, well, I'm entering this trade at 5.71. If the stock is at 90 at expiration and my strike price is 100, it's going to have intrinsic value of 10 points. And so in this way, I don't really worry about time decay. I don't worry about changes in implied volatility, which can be difficult. But if I'm confident that the stock's going to fall and stay down and be close to 90 at expiration in 90 days from now, that put option is going to be worth about 10. So I'm very happy to pay 5.71. I can almost double my money with that. So that's one way to get around that, is just think, where is this thing going to be? What kind of intrinsic value is it going to have close to expiration, or even close to, you don't even have to wait till expiration. If I think that the stock is going to move down to 90 right away after earnings, and so, no time decay, let's say the volatility drops all the way down to 10, these things are still going to be worth, very close to $10 a share, because it's 10 points in the money. So that's one way to think about that. So again, long puts make money if the stock goes down, implied vol goes up. They lose money. They're melting ice cubes over time. They lose money due to time decay or theta decay. But that time decay will only affect the extrinsic value. So that's, again, why we can really think about what does the intrinsic value of a long put option look like. And that's sort of a floor on the put option, because as we saw at the beginning of this lecture, a put option is always going to be worth at least how much it's in the money. Now, unlike short call positions or short option positions, short puts, short calls, you have zero risk of assignment. I thought I'd mention that when you're long the put. You have the right to exercise the put and put it away on someone, but normally you're not going to do this. You're just going to exit your long put before expiration. And again, to do that, you're just going to use a simple sell to close order. So that's basically everything you need to know about long puts as a standalone strategy.